All right, good afternoon, everybody. Don Wenner here, joined by my associate, Rich Delgado, and excited to chat with you here. We're going to dive into our webinar as part of our series of, we call it Today's Market and Investing. It's been our first one we've done in a few weeks, so appreciate you jumping on. We got a lot of exciting stuff to talk about as we shared out with a couple of the emails that probably drove you to jump on here with us today. So with that said, I'm going to go ahead and dive in. Reminder, there's a Q&A box here if you're in Zoom that you can type any questions in, and Rich will ask those as after we go through the presentation here. And then if you're on social media, of course, you can type in questions there as well. And I believe Kyle is monitoring that for us, so feel free to type questions in. And with that said, I am going to dive in. Quite a bit to cover. I know that the topic that's been getting the most questions is this big portfolio that we're going to talk about, but a couple other exciting things to share as well. So looking at the list of names here that's continuing to grow, people joining us, and I see lots of familiar names, but quite a few that I don't yet know. So I'm going to take just a quick minute and give an overview about DLP for those of you who don't yet know that much about us. And then I'm going to dive in here to some updates for all of you who do know about us, and some exciting updates I think everybody here jumping in will be interested in. So first, DLP Real Estate Capital is our parent business here at DLP. I started the organization 14 years ago in Bethlehem, Pennsylvania. And actually that kind of piece of that picture you see at the top of your screen is actually at our grand opening of our headquarters about a year and a half ago in Lehigh Valley, Pennsylvania, where we're still headquartered. And then we have a family of businesses that support our parent entity, including DLP Capital Partners, which is our investment management, fund management business, which is the arm of our business that we're really talking about here today, and the investment opportunities that we provide to investors such as yourself and including many of you. So at DLP, the center of our universe is our people. We now have nearly 400 incredible people driving results here in our organization. Those 400-ish team members all row in the same direction, all focus on driving these 10 core values you see on the top and the bottom of your screen here, all driven around our purpose of dream, live, prosper, which is what DLP stands for, passionately creating prosperity through real estate. And we're on a mission to lead and inspire the building of wealth and prosperity with our partners, that's you, through our relentless execution of innovative real estate solutions. In that path of executing on our innovative solutions, I'm pretty proud to say, and for some of you who've been with us for a while, you guys have tracked as we always share our assets under management. We're constantly updating it. And this is a pretty big milestone here that we just hit this past Friday. So thank you to all of you, our existing investors, as we passed $1 billion in assets under management, which I don't care what realm you're talking about. $1 billion is a big number, it's a big milestone. It's pretty cool. In the scheme of things, it's going to be a small milestone when we're sitting back here having a webinar like this years down the road from now. But considering it took us 14 years to hit this mark of consistent, steady growth, in fact, over 60% growth annually, which we also found out yesterday, we are the fourth fastest growing company in America out of any companies that have been able to make the Inc. 5000 list 8 times or more. We've been on the list 8 times in a row for our growth, fourth fastest growing company in America. So this is one great milestone as a part of that growth, which is pretty cool. What helped us hit that $1 billion mark was the close of this most recent acquisition, which is in the DLP Housing Fund, which is called The Preserve at Port Royal Apartments. It's a 400-unit apartment community in Port Royal, South Carolina, which we acquired on Friday. This again pushed us over $1 billion in acquisitions. This was over $1 billion in assets. This was a $50 million acquisition where we deployed about $10 million of equity. This is a community built in 2004 to 2006. It's a coastal community, basically between Charleston and Savannah. And you'll see here some of the pictures. So on the left, this is what most of the apartments look like. So these apartments are around 15 years old, in good condition. They're just around 15 years old. This is what the vast majority of them look like. The previous ownership, which was the developer who built this community, they renovated some of the units, only a handful, into what you see some of these pictures in the bottom left. They also recently had renovated the exterior, redid all the siding, really spruced up the landscape in the exterior, improved the gym and some of the amenity space as well. So we're going to really take the upgrade plan that they started and finish out that plan to continue to drive revenue in addition to just overall improved management. We deployed in total here about $9.9 million of equity into this asset. Again, it's 400 units. Mainly are 2- and 3-story apartment buildings, but there's a few carriage style buildings, which means there's an apartment above a garage. Again, built in 2 phases between 2004 and 2006, 2 swimming pools, clubhouse, outdoor grilling, dog parks, playgrounds, and average rents today of about $1,243. So a little bit of the stats here. See the rents, they range between $1,000 and $1,350 today. You see our pro forma rents here. So basically we're targeting on average, taking the rent from $1,243 to $1,318, not a huge bump, but makes a big difference in our cash flow. And that's the blended increased rates. And then you'll see here with the return target. So the levered return, meaning the return including the factor that we levered this with bank financing, is 21.7% annual IRR. Year one, as we renovate units and we have a little bit lower income because we're going to have units offline being renovated, will be 7.6% cash on cash. And then we move into double-digit yields in year 2, 3, 4. The reason it goes down in year 3 and 4 is because year 1 and 2, we have an interest-only loan. Then we start paying our principal. We could start paying it sooner as well if we chose, but we have the option of interest-only here in the first 2 years. So $54 million total purchase price. We were actually going to buy this asset for $60 million right before COVID, and we were able to renegotiate it down to $54 million, which is about a 10% savings. And considering the property is actually performing much better now than it was pre-COVID, was a heck of a buy. So we feel very excited about this asset. And then you'll see here, for those of you who are pretty familiar with real estate investing, you'll see here all of these return targets here are based upon, or I should say this IRR target here is based upon assuming that in year 5 we're going to sell this asset at a 6.5 cap rate. If we were to go and do some basic management improvement here and turn around and sell this asset in 6 months from now, assuming the market's somewhere around where it is today, this property would sell sub 5 cap rate. So we're very conservative with what it'll sell at. Still to be able to hit 20+% IRR is very conservative with our ability to grow rents. So going to be a great acquisition, produce great cash flow, and is a phenomenal addition to the DLP Housing Fund. So I know that deal, as exciting as that deal is, and that's closed. And for those of you who are a DLP Housing Fund investor, or if you're evaluating the housing fund, the full overview on that investment, the full summary of that investment will be uploaded into our investor portal by tomorrow. So you can look at all the pictures and all the overview and details on that investment. And then you'll start seeing in our reporting here for Q3 the performance and overview on that asset as well. So really excited about that asset. Our biggest acquisition of the year, one of our bigger acquisitions to date, but it's small in comparison to the deal we're working on right now. So first, let me mention that this is not a done deal yet. We are not definitely buying this deal. We are under executed agreement today. We are in deep due diligence right now. We've had about 20 different DLP team members flying and driving all around this portfolio much of the past 2 weeks. Many team members still out in many of these communities here, and we still have a tremendous amount of more due diligence yet to do. We will end up putting in tens of thousands of hours into due diligence before we finalize this transaction and move forward. So this is not a definite at this point, but it's far enough along and likely enough that we wanted to share the exciting news, with you guys as our investor base, start getting the word out. As once we do finalize this deal, we're going to be in heavy growth mode to bring in the capital to close on this transaction. And then also want to share the overview on this investment, because we've realized here over the last number of years that we can provide even better value for a whole lot of reasons in acquiring portfolios. And you're going to see a good amount of trend in our acquisitions moving forward, focusing on taking down portfolios. We've taken down portfolios as large as about 1,200 units. We've taken down multiple portfolios over 1,000 units in the past, and they've been some of our best performing acquisitions. We often end up acquiring a lot of the existing team as well, and it works really well for a whole lot of reasons. So this, of course, is the biggest acquisition we've contemplated to date, or at least gotten far in the process on as we are here today. So without further ado, let me dive in. So we are calling this the Dream Live Prosper 2X portfolio, because this portfolio will basically double our existing portfolio. And I'm going to show you a little bit about how this portfolio compares with what we own today in a moment. This is really just a continuation. It's a big continuation, but it's really just a continuation on the strategy we've been deploying, over the last number of years. We've acquired over 15,000 units over the past 5 years, over 70 communities. We've been picking up that pace year over year. And this is just a way for us to do it on a larger scale in one transaction, but we're not going out there and acquiring a 11,000 unit community. We're acquiring over 40, 2, 3, 4, 5, 600 unit communities, just like we've been buying over the last number of years. So this portfolio is 43 communities, to be specific. These are primarily what we would determine to be Class B communities. They range in smallest from 112 units in size to largest 850 units in size. This is actually being structured as one M&A transaction, meaning we'll actually be acquiring the company as well, including the management team, which is a staff of more than 300 team members. So we make this acquisition, it'll drive our overall organization size to over 700 team members. One of the things that's arguably most exciting about this portfolio is that often, and this is kind of anybody, if somebody such as ourselves here at DLP, when you're growing a portfolio like we have, one of the expectations is that when you grow your portfolio, you increase in size, then a larger capital player will come and buy you, and will buy you at a compressed cap rate. They'll pay a premium to get scale. So usually when you build a larger portfolio, you can sell at a higher value, because people would rather, especially big Wall Street money, would rather buy a large portfolio at once. We're actually getting a discount on this portfolio from what we would buy almost any one of these individual assets at. We're buying them together at a significant discount. So the trailing cap rate, meaning the current the cash rate, the returns or profitability over the past 3 months and past 12 months are over a 6 cap rate, meaning the trailing numbers, meaning if we bought it and did nothing better or different than how it's been performing already, we'd be getting over a 6% cap rate. Most of these assets, if they were selling independently on their own, they were being marketed well and managed reasonably well, they'd be selling in the 4 cap rates. So we're getting a pretty significant discount, and we will be able to drive up our unlevered yield, or our cap rate, to over 7% very quickly, and be generating double-digit cash-on-cash returns. And similar to the last deal we just went over, the Preserve Port Royal, we'll be able to generate annual IRRs over 20% on this portfolio. So we're going to come into this portfolio and deploy a very similar playbook to what we've done many times. Improve the management. There's a lot of opportunity for management improvement here. Improve and elevate the on-site team. We're going to tackle a lot of deferred maintenance, things we call quick wins, really make the landscaping and the property pop, improve the amenities. We're not modeling, contemplating a ton of full renovations for a few reasons. One of which is that the average asset is in the early 1990s. So these are generally a pretty good condition, newer assets. And then we're being very conservative with the amount of capital we deploy, granted the state of the economy and where we're at. And we know we're going to have so much growth with lower hanging opportunities through stronger management and deploying more cash into the assets. So this is the overview of where the portfolio is located. So all these little markers in red are where the communities that we're looking to acquire in this portfolio are located. This is where DLP's existing communities are located, all these blue markers. This is where we own communities today. This is combined. So you'll notice that it lays out very nicely within the portfolio we already own. Fills in almost perfectly, many cases right in the exact same markets we already own, or fills in kind of some of the blanks between some of our existing portfolio. So it works really, really well for us in building density, which helps us to build our strong management infrastructure throughout these markets and get benefits of scale throughout these markets. So it's a really, really nice portfolio. I would argue that there's not a portfolio out there that anybody owns closer to this portfolio we're looking to acquire than the portfolio we already own. It's very, very similar, albeit the portfolio we're acquiring is on average a little bit higher quality asset, a little bit bigger average community, a little bit newer average age than what we own today. So, but it lays out really nicely with our existing portfolio, as you can see. Let me show you some of the pictures. So these are just some of the actual pictures of the communities. You'll see some of the exteriors, some of the interiors, some of the amenities throughout the portfolio. So you'll see, a wide range of, ages. Some of the oldest communities are 1970s. The newest are 2011 at 12, but the average is 1990s. Average community size is just under 300 units. Some of them are on the water. Some of them have water running right through the communities, create some really cool features. Really well-built communities, the vast majority of them, really well-designed, really excellent locations as well throughout the portfolio. So we, right now, and I'll throw out, for anybody who wants to say, hey, which properties which, want to know all the details, because right now we're still finalizing all the details. We're keeping all the exact details confidential yet at this point until we have everything completed here. And then we will gladly share out once we have all of that, everything done, that we can then share the exact community names and full details. We'll do so. But right now we're sharing as much as we can under the current state of the agreement and state of transaction, but enough that you can get a good feel here of the assets and where it's located and the quality. And then hopefully by our next time we meet again here, which we'll talk about towards the end here in a few weeks, and likely even before then, we'll be able to share the full details on the portfolio. But obviously these pictures give you a good idea to the quality and types of communities we're acquiring. This is really on the older end of the communities right here. This would be late 70s, early 80s construction. So with that said, our expectation is that the majority of the equity that goes into this portfolio will come from the DLP Housing Fund, which for any of you who are new to us is our $1 billion evergreen REIT. This is our only fund today that invests in owning real estate. This is our flagship fund. It's the 8th fund we've launched. This is a fund focused on making equity investments primarily into Class B value add communities, which certainly this portfolio exemplifies. The DLP Housing Fund currently owns about $250 million in assets, a little over 5,000 existing apartments now, including the most recent acquisition that we just talked about. This fund provides all the tax shelter benefits of owning real estate, of depreciation, but is even more tax efficient than owning real estate directly or investing in most closed-ended real estate funds from my perspective, in that it provides the liquidity benefit that you can exit and take your taxable income at the time that's best for you, while being able to have the benefits of 1031 exchanges, within a fund structure that most real estate funds don't have that ability to do. This fund has the option of paying out monthly distributions to you as an investor, or you can reinvest, and provides annual redemptions options as well. This fund is designed to produce 6% annual preferred return. That's paid to you before we earn anything, paid to you before we even earn our management fee of 1.5%. And then we pay out all the additional profits over that 6% minimally on an annual basis. And then once we hit that 6% preferred return to you, an 80-20 split until we hit the target return, which the target annual return of this fund is 12% net to you. After we exceed the target, then we get 40% of the profits, you get 60%. So we're incentivized to exceed return targets of 12%, which we've done in all of our funds. And then other point here to mention, in this large portfolio will be no different. DLP always invests heavily into the assets that we put your money into. We have here in the housing fund that we will invest a minimum of 5% of all the committed capital. Today, we're over 20% of all the committed capital in the housing fund. We're about 40% of all the equity in our entire about 11,000 unit portfolio. In the most recent acquisition, the Preserve at Port Royal, we put in, through my entities, put in about $1 million into that asset. Frankly, would have put more in, but we needed to deploy your money in the housing fund. As many of you guys want to get your money deployed, or I would have invested even more money into the deal, but invested $1 million out of our DLP's $8+ million investment. So we invest heavily right into these assets, right alongside you as our investors. So what I want to show you lastly here, and then I'm going to hit on a couple other updates and exciting things to share, and then I'm going to open it up to questions. Right now, the housing fund, I'll show you what we own today. We have a 739 unit community in South Bend, Indiana. That was one of our first acquisitions. I think it was actually the first. We have a 4 community portfolio in Baton Rouge, Louisiana that make up about 700 units. We have a 240 unit community here in Columbus, Ohio. We have 2 communities in Vernal, Utah. These are mid 2013, 2015 vintage units. We have 2 communities in Shreveport, Louisiana. We have a community in Valdosta, Georgia. Actually, that was our first acquisition here. Our most recent acquisition this year, prior to the one we acquired last Friday, was Dream Devonshire in Scotts Depot, West Virginia, 340 units built in 2008. We have a community in Sierra Vista, Arizona, built in 97. And then we have 3 total communities, 2 communities next door to each other here called Prosper, Pleasant Point. And then, we have 2 communities in Little Rock, and then we do own a 3rd community in Little Rock that we bought before the housing fund. So we own 3 total in Little Rock, but 2 in the housing fund. And then last but not least, we have Dream Aspen Creek, which is in Broken Arrow, Tulsa, Oklahoma, which we bought from a merchant builder, built in 2018. So you'll see a wide range from earliest or newest of 2018 to oldest of mid 70s across the board, very similar to the portfolio that we're looking to acquire, that we call, again, the 2X or Dream to Prosper 2X, or 2X for short portfolio. All right, so that's the update there on that portfolio, but I know there'll be questions. I see many in the chat box, so I'll jump to those in a second. Before I do that, I want to share a couple other updates with you. First, our next live event is going to be October 8th in Asheville, North Carolina. That's where I'm actually talking to you from right now. I got here about 1:30 this morning here to Asheville from Florida. I'll be back up here again in October to host our live dinner event and real estate investment presentation. We're going to take kind of a unique and different kind of approach to that event, which we'll be sharing out weeks ahead, which we're excited about. That'll start at 5 o'clock. We also will stream each of these events virtually as well. So you're going to join us virtually here on Zoom or social media, or love to have you join us live. And then October 29th, fingers crossed, will finally be our first live event in Pennsylvania since January. So really hopeful there that Pennsylvania doesn't make it too hard on us, and we can host a big live event in Bethlehem. The Arts Quest, we're all booked and reserved.
So it sounds like Don is reconnecting. So forgive us 1 second here, folks, as we continue going through it. And it looks like Don is coming back.
Oh, can you hear me now, Rich?
We can. All right, we're good to go.
All right. Sorry, I got dropped off there somehow. So 4 o'clock, same place where you're at now. Hopefully we'll be sharing a lot more details on the 2X portfolios. We'll be on the end of concluding our due diligence. Again, you can join here on Zoom or Facebook Live. And then I want to share here, give a first kind of taste here to many of you. The weekend of November 12th to the 15th, it's going to be our official launch of the DLP Prosperity Membership. Full name is the DLP Prosperity Family Wealth and Legacy Membership. And this is going to be fun of our first kickoff event. And it's going to be really a 3-day, we call prosperity event. We're going to focus on a number of things, but really as the title of the membership states, it's about family, wealth, and legacy. So we're going to we're going to have a number of expert speakers. One of the first kind of key speakers we signed up is Ron Cordes. Ron was the founder and CEO of AssetMark, which is a publicly traded $50 billion fund manager, and is a thought leader in the world of impact investing, has done a TED Talk. We have a couple authors signed up already. We have a NBA superstar basketball player who's got a really cool story, is going to come speak. So we're going to have a lot of really cool speakers on a wide range of topics, from personal development to health to philanthropy to family wealth to legacy planning to tax planning. It's going to be a really, really cool event. You'll be seeing more information on this, so don't think you have to rush and write it all down. You'll see it on our website here shortly. We'll send follow-up emails on it. And we welcome you to reach out to one of our team members and express interest if you'd like to join us. It'll be really, a really incredible event. You get to join us in Ponte Vedra Beach, which again is right next to St. Augustine. We're staying at a really awesome hotel in Sawgrass. I thought I had that on the next slide, but we'll send it. I think the Marriott Sawgrass, I believe it's called. It's a gorgeous hotel resort. Again, we'll send out a lot more information here, but want to get the first kind of inclination here. So at least if you think this is something, COVID pending, you could join us on. You could at least save the date, and then we'll follow up with you, or you follow up with us on learning more about the event and deciding if it's something you can make happen, and come spend some time with us. So again, you'll hear much more on that if you stay tuned with us. But really, really excited for the launch of the Prosperity Membership, and we're going to kick off with this event. And you'll get to join us live on the 12th at our Capital event, and then stay for the weekend and have a really great time. We're gonna have some fun as well. We're working on some really cool things on the fun side, outside of learning and self-improvement as well. So gonna be an amazing time. So with that said, I'm not probably at the next meeting. I'm gonna do a full welcome here, but felt made sense here, considering this Monday we officially welcomed Bo Parfait to the DLP team officially, and I'll have him at the next meeting, next one of this next webinar, give his formal intro. But wanted to kind of share, Bo is actually the gentleman who brought me the idea of the DLP Prosperity Membership, and has led the fostering of this idea that's come to be. And Bo originally came to us as an investor, and brought us many investors or are currently investors here at DLP. So he is now a managing director at DLP Capital Partners, and he's also leading the DLP Prosperity membership as well. Really awesome guy. He wrote an incredible book as well, which I encourage you guys to read. We'll send out about him climbing all 7 summits in all 7 continents, which is pretty cool. But with that said, I'll let him tell more about himself in our next meeting, but wanted to make sure as you guys start seeing Bo and seeing his information, you knew who he was, and he'll be speaking and helping lead the event in November as well. So with that said, as always, after this event, you can reach out to any of us here to follow up for more information, whether it be on the housing fund, the 2X portfolio, come into the prosperity event, or anything else. We'd love the opportunity to serve you and follow up and help you. So with that said, Rich, let's dive into questions.
All right, and we've got quite a few of them. So just remember, you can continue to ask questions by typing them into the Q&A function or the chat box, but let's go at it since we have about a half hour and we're going to try to get them all in. So first question comes in from John. What do you see as the biggest risk or risks associated with a transaction of this size? And let's see, I think we may have lost Don for a second there. We'll give him another second to join us here. And again, a reminder, as you see on the screen there, if you have any questions, you can always reach out to myself. You can reach out to any of the other investor success managers on our capital team. But again, we'll give Don a second here. Looks like he popped off. So I'll go ahead and remind you, let's just put this back up on the screen here. All right. So again, we'll give Don a second to join us. I'll go ahead and start answering some of these questions here as we have them as we're going through. So just bear with me one second. Starting to get more questions coming through. All right. So Robert asked, can you update us on rent collection? So I'm going to leave the big portfolio questions for Don when he gets back on, and it looks like he's joining us now. All right.
Can you guys hear me now?
We can. Excellent.
All right. Sorry, lots of issues here. So, but I did hear the question. So rent collections. So in terms of our rent collections here at DLP, it's gone extremely consistent and very well. So we've ended up every month since COVID, April, May, June, July, all right around 94.5% each and every month. So it's been consistent. Effort has been tremendous on the management side. Just now, here in the last couple of weeks, we've started to move forward with evictions in certain states. Up until that, as you know, we have been not able to evict. What's been great is the majority of our residents, we have close relationships with them. They've made every effort to make payments. It's been the minority who kind of worked the system and just said, we're not paying rent because we know you can't do anything about it. So we've collected a pretty good amount of our rent, again, about 94.5% on average. And our physical occupancy has broken all-time highs once again this week. Every week's been our all-time highs. So our cash flow is higher now than it was pre-COVID. And as we start moving out those residents who are purposely not paying or in some cases just unable, we'll be able to refill them because the demand is very, very high, decrease our delinquency and increase our cash flow.
Excellent. Thank you. So Don, we're going to go back to the first question that came in from John that says, what do you see as the biggest risk or risks associated with a transaction of this size?
So the nice thing is at the end of the day, every asset is its own standalone asset. Each asset we're able to underwrite just like any other deal. So at the end of the day, it looks like a really big transaction. It is, but really we're not, again, buying one billion-dollar asset. We're buying 40 assets, each worth around 25 million, which is a very average acquisition for us. So right now, we have to go out and put the same level of due diligence and effort through on each asset as if we were buying one at a time. So it's a magnitude of work to underwrite 43 assets, financially walk through 11,848 units and fully inspect them and do all of our due diligence and so forth, all at the same time is a lot of work. But fortunately, we have 400 incredible people and we'll be able to get it done. But otherwise, it's just a larger magnitude. So I'd say the only, larger, I guess you could call a risk above and beyond just larger scale is, we have to be confident before we finalize and conclude our due diligence that we're going to be able to put together all the capital, which we're extremely confident we'll be able to do. But our heavy preference is to be able to bring in all or nearly all that capital directly from our investor base in the DLP Housing Fund. We have many large institutional partners who are begging us to partner with us on the portfolio, but we would love to keep the capital here within the funds. But that's the big thing. We have to be comfortable that we're going to be able to put together the capital and transaction this size all at the same time, which we are working on right now, hence why we're here talking with all of you here this evening.
Excellent. Thank you, Don. And there's another question that comes in from Joe that asks, is there a cash out refi option with this acquisition or with the housing fund in general at some point? And if so, when do you expect this to happen?
Yeah, so this portfolio is actually going to be acquired in a mix of, right now, all of the debt is agency debt. It's Fannie and Freddie agency debt. But we've already done full analysis of all of the loans. And what will likely happen, we're still making these decisions, but what will likely happen is we will replace some of the debt with new debt and some of the debt we will assume. The nice thing with agency loans is you don't have to refinance them. You can do supplemental if you want to pull cash out. So with time, there will be some supplemental, meaning we'll be able to pull out some capital to then deploy into, say, unit renovations through supplemental mortgages, meaning Fannie or Freddie will allow us to take out more of a loan balance based on the increase in value. But yes, throughout our entire portfolio, we use leverage. It's a phenomenal tool. We've always used leverage conservatively, so we don't make an effort to constantly maximize leverage, meaning every opportunity we're looking to refinance, pull out every dollar and lever up. So across our real estate portfolio today, we have mid to high 50s leverage. In the housing fund, we're probably mid to high 60s. It's a newer portfolio. So as we drive up value, yes, we will refinance, whether that be to drive down interest rates or to pull capital out to redeploy in our portfolio. But yes, that's always a component of our investment strategies for sure. And one of the great things right now is everybody knows that interest rates are incredible. So new debt we'll be placing, example, on this big portfolio, will be in the high 2s to low 3s, all in interest rate. It's incredible.
Great, thank you again. And I think you answered part of this question, but it's a two-part question. First is from Michael, is the seller of the 2X portfolio under some stress? And will this be an asset purchase or will you assume any existing liabilities?
So I'll first start and say if you wanted to define distress is I guess, how you want to define it. I'll call it first world problems, right? So the gentleman's a billionaire. So let's start there, right? So he's not going to be living on the street, regardless of what happens with this transaction. He's a very, very, very wealthy man. But with that said, he's large in a number of other asset classes, including energy, that have been hit pretty hard. So he is selling this portfolio because he does need a large amount of cash for other business needs. So yes, that need for cash and the desire to get that cash quickly, not because the portfolio is in distress, but because he has cash demands in other areas in his conglomerate of businesses, is what's causing his willingness to take less than market for surety of execution and a relative speed for a transaction like this. Was there a second part to that question, Rich?
Yeah, no, I think you answered it. I mean, again, the questions right now we're going to go to is going to come in on the heel of what we were just talking about, which is around the returns. So it's a two-part question, two different people, but the first one is, can you help us understand how a 6 cap rate and a 20 IRR translates into achieving a 12% targeted return and above? That's question number one. And then the second question came in from Joe that asked, again, did he hear you correctly saying you distribute 12% plus net annually? So again, if you can answer those questions, that'd be great.
So the target of a 20% IRR, which is what the minimum threshold is of any investment we buy, is the return to equity. That's the annual return to equity. So obviously, if we're buying deals that generate 20% IRRs on our equity, our returns are going to be greater than 12% returns to our investors. That's not a mistake. It's not that we didn't realize that. It's that we purposely stress test things at the fund level to be even more conservative. So at the asset level, we have to hit a 20% IRR. We have to hit 10% cash on cash returns. And that's based on a lot of stress testing. So in general, as examples, we assume on average, we're assuming rents are going to go up 2% a year and expenses are going to go up 2% a year across our portfolios, even though historically and definitely over the past decade plus, rents have grown tremendously faster than that. We're very conservative in our expectations to growth and income. We also assume that when we sell a property that there's going to be a softening in the market and that we're not going to be able to sell the property at nearly the same cap rate we could sell it at today. And so we assume conservative exit prices as well. We don't assume and model out aggressive recapitalization of the debt, like one of the previous questions was asking, that could jack up returns. We don't go and assume that we're going to sell the property in just 36 months, which jacks up your returns when you're doing value add. So we're very conservative at the property level to get to our 20% IRRs minimum. And then we stress test that further to be able to still hit 12% net to our investors. So sort of slice 20% off those returns, and we still get to 12% net to you as an investor. In terms of the second question, yes, the annual return target net to investors is 12% annual return net to you as an investor. You have the ability to take that income as direct distributions on a monthly and annual basis, or have it reinvest into your account.
Excellent. Thank you. And I've got a couple of different questions that all relate to how we're going to raise enough money to acquire this portfolio and where it will be financed.
Yeah, so we will be financing this portfolio through predominantly agency debt, either through assuming existing debt and or replacing it with new debt, depending on a few factors. And then the rest of the capital will come in through equity. So the equity will be, as mentioned earlier, hopefully the majority, if not all of the equity, will come through DLP, meaning myself and the GP. There are members of the ownership here at DLP, as well as you as our investors in the housing fund. That's our preference. Depending on the timetable of the deal and the amount of capital we raise, we may bring in a partner, such as a large insurance group, as an example, to invest capital alongside of the housing fund. So we started and had many of those conversations already, and have frankly have a lot of groups who've already given us very strong terms to provide a significant amount of our equity. But we're holding off on committing to any outside equity partners, as our preference is, again, to provide as much of the return and the opportunity on this deal to our existing investor base into the housing fund.
Excellent. Thank you, Don. Switching up just a little bit, I've got a question here from Derek. It's, again, two-part question again. What is the competitive edge at DLP? There are plenty of smart, hardworking people in the world. So what makes DLP Capital special?
Yeah, so it's a good question. So, I mean, to the point, yes, there's lots of really smart, talented, incredible people in the world. There's also lots of good companies in the world, and good managers out there. I think a couple of things that make us unique. Number one is we combine nearly 400 really incredible, hardworking people, all in the same organization, all operating under the same mission and direction, all sharing the same set of values, all operating on a very disciplined operating system with very clear goals. We operate a system here at DLP we call the lead execution system, and bar none, we accomplish more each 90 days than our competitors accomplish all year. So combining a lot of great people with a very executed, disciplined approach to our growth is in not just doing that in good times or for 1 month or 1 year or 1 quarter, but doing that day in and day out, year in and year out is easy to say and hard to do. And that's why we're the 4th fastest growing company in America of anybody who's been able to stay on the Inc. 5000 list 8 times or more, because we've done this now for 14 years really, really consistently. And I think if you look at us as an investment manager versus other investment managers, you'll be hard pressed to find the level of consistency to the growth, the consistency to the returns, the consistency to the approach.
Excellent. Thank you again. A question coming in again on the portfolio, the 2X portfolio from Mike. What is the onboarding strategy for almost 300 plus new team members? Do you have a team in place for this?
So we don't have a final onboarding plan yet, and I guess maybe I should highlight, if we get through due diligence on this transaction and we move forward, we're talking from today, settlement in 5 to 6 months. So it's going to take a lot of time, as you would imagine. So this is a Q1 2021 actual closing. We would like to take down the portfolio in tranches. We're trying to make that work. There's some complications on the seller side with structuring, meaning we'd like to say, hey, let's take down 2,000 units in October and 2,000 units in November and 2,000, and break it up, which would help for a whole lot of reasons. Not yet sure if we're going to be able to do that or not. If we're not able to do it, it's going to be 5 to 6 months till we close on the whole portfolio. So with that said, this is not the first time we've onboarded a lot of people at the same time. We've done acquisitions of operating companies multiple times. We've done large acquisitions of portfolios multiple times. Recently, we took over the management of 2,000 units we owned that we were managing with third parties. We took over them all on the same day, and added 70 or so team members on one single day. So this is obviously even bigger than that. So we'll be spending a lot of time once we finalize, as we finalize our due diligence on evaluating the 300 plus people, determining, where we're going to need to put replace team members before they even start with us, where there's going to be a need to do that on I'll call it day one. And then we'll be hiring right away. We'll be hiring some corporate level or regional level leadership that we'll onboard prior to onboarding the portfolio. So we'll onboard some resources that'll be in place to then handle the onboarding of the assets and the people over at that period of time, especially if we onboard them all at the same time. So hiring talented people and planning and for large growth in team members is something we do really well. We welcome, for the last number of years, we've welcomed 12 to 50 new team members to DLP every single month. So onboarding a lot of people at the same time is not new to us. And in this case, we're going to have a lot of time to plan for it, but it is going to be a lot of people. And then how we do so and we integrate with our existing team, we're still figuring out. We may onboard this whole team first as a separate management company, and then manage merging them into our existing team as kind of a phase 2. We're still figuring that out, but those are some of the things we're contemplating right now. And then I will mention lastly that Melanie, who's our president of our management company, at her last company, they acquired multiple portfolios of this kind of size. They acquired multiple billion-dollar portfolios, multiple portfolios of 7, 10, 15,000 units all at the same time. And she spearheaded this kind of takeover before, so this isn't new for her.
Excellent. Thank you very much, Don. I'm going to ask one more in relation to the 2X portfolio coming in from Keith. He says, I believe you list St. Clair Holding as part of a joint venture on this new project. How does this impact our profitability with the investment?
Sure. So thanks for that observation, Keith. So this property we just bought, Rich, maybe you want to scroll back to that to the preserve at Port Royal for us there.
Absolutely.
So in this property we just bought, we have a partner in this portfolio, company by the name of St. Clair, and so they actually are the ones who sourced this deal and brought this deal to us to partner with them. So what they bring to the table, number one, is they've done a lot of similar deals to this. They're located out of Atlanta, and they've done a lot of similar deals to this. They're very
clean your hands often and thoroughly. Cover your mouth.
Don't know what that noise is.
Larry, I think we need you to mute.
There we
go.
So St. Clair is, they're very good asset managers. They're very hands-on. They've spent hundreds and hundreds of hours out of this asset already. So go to the next slide there for me, Rich. So they'll be working directly with us on executing this business plan. At DLP, you'll see their name right here, St. Clair Holding. At DLP, we have 100% control over the management, over the operations. We have the ultimate controls, but we're sort of giving them some of the day-to-day controls under our guidance and direction to kind of put in I call the sweat equity on the ground of working with us. So how this $9.9 million equity works is at DLP, we put in 80% of the equity, and St. Clair put in 20% of the equity into this deal. So their equity actually only benefits our returns because we put in the majority of the equity. The way we structured the returns is that we get all of the cash flow on the deal each and every month until we get a 9% return on our money, and then they get a 9% return on their money. But we get all the cash flow first, and then when we sell the asset, we get all of our cash back first. We get a 12% IRR on our money first before St. Clair even gets their money back. So they help insulate us to make sure we get even better current cash flow, and they insulate us in a things were to go bad standpoint, and that we'd actually get a 12% return and get all our money back, and St. Clair could actually lose money. And they invested $2 million. It was real money sitting behind us in the capital stack. So they only help insulate us. Ultimately, we certainly, as you can see from how we modeled this deal, at 21.7% IRR, don't expect to be in that situation where it makes a whole lot of difference, but having them insulating us is of course a positive.
Excellent, Don. So we've got, I'm going to ask just one more related question here, and it's more around pipeline. And the question is, and this is a common question we've gotten a thread through here around deployment is, are there any other acquisitions in the pipeline being made into the housing fund to allow for deployment sooner?
Yeah, great question. So we just deployed, about $7 or so million last Friday. We are negotiating. We're in the final stages on negotiating a transaction that'll close in September. I should say we're in final stage of negotiating our final due diligence to move forward on a transaction that'll close in Charleston, South Carolina. in September. Actually, right now the closing date is scheduled for September 11th. So that's 30 days, a little less than 30 days, 4 weeks out. So assuming that transaction happens, which is about a 350 unit acquisition, our equity check on that deal is actually also about an $8 million equity check. So that'll deploy most of the capital that's sitting right now in the housing fund that's come in the last number of weeks. And then we have a couple other deals that we're very close to wrapping up right now as well. We have one in Oklahoma that we're negotiating right now, one in Louisiana. They're both between 20 and $30 million transactions. That'll be $6 to $8 million equity checks as well. That'll be closing in pretty short timetable. So yes, we have a strong acquisition pipeline, and we'll be having more acquisitions closing here over the next couple months, above and beyond the large portfolio, which, unless we can break it into chunks like we'd like to, won't be closing for another 5 or 6 months.
Excellent. And then switching over to the market a little bit, Harant asked, how will DLP overcome the growing cases of COVID?
So I'll say that at the end of the day, we're going to overcome whatever COVID, whatever the states, whatever the government, whatever November throw at us, the same as we have, these last 4 months, which is first and foremost at DLP, keeping our mentality of what we call the 20-mile march, which is controlling the things we can control each and every day. Not letting ourselves get caught in the noise around us, and continuing to make sure we do what we need to do. And at the property side, that means we need to continue to collect our rent. We need to continue to service our residents. We need to continue to lease units. We need to continue to take care of our properties. And that's one of the things I'm most proud of that we've done incredibly well through COVID. And on the lending side, it's we're going to continue when there's distress and there's state shutdowns and there's volatility and there's fear. That creates opportunities, and not just for us as an operator, but for our borrowers. So we're going to still be there. We're going to be making good decisions, be conservative, pay close attention to what's going on in the market, and continue to communicate with you as investors, with our borrowers, with our residents, with our team members, and give confidence and clear direction to what's happening around us. So there could be, with COVID taught us anything, it's taught us that we don't know what could happen or what could come, no matter how much we try to prepare and plan and put ourselves in a position to mitigate risk. But I'm very confident that we've built the right organization, the right structures, and we're investing in the right asset class that's going to put us in a position to weather volatility as well as anybody else.
Excellent. Great. And then similar question on the market. What market scenarios worry management team and you, Don, at DLP Capital Partners the most?
Well, I heard the worry
what
part.
Market scenarios? What market scenarios worry?
Great. So market scenarios, I think everything has pros and cons, right? So I get the question a lot. Well, what happens if the CARES Act doesn't get extended, right? And I think the bigger thing that people think about is if people don't keep getting the additional unemployment benefits, right? Well, obviously the extra $600 a week that 7 or 8% of our residents have received through this time frame, it's not the majority, it's the minority, has been helpful to those residents, right? And it's helped them to pay rent. But on the other side, of course, that came with that CARES Act was the fact that we were stopped from being able to evict any residents, right? So if the CARES Act doesn't continue, we can move out residents who choose or can't pay their rent and replace them with those who can, and do so, as humanely as possible. I don't want to make that sound as harsh as that can sound, but make sure we have residents in our properties paying rent. That's going to tremendously benefit us. The other part of the CARES Act that has been very impactful is the PPP funds to small businesses. And a lot of small businesses have frankly hung on only because of PPP funds. And that's a really good thing for America. It's a really good thing for small businesses. For us at DLP, if the PPP funds had not come, a lot of our competitors, whether it be competitors competing to buy properties with us, competitors competing at other lender competitors, competing to get the better borrowers and deals, they would have been out of business, and that would have created more opportunities for us. So, everything kind of comes with pros and cons, and the ability to be able to adapt and adjust accordingly. So, I think, November is going to be interesting, the election. But again, I think I don't allow myself to get too overreact to things. I don't think whoever wins in November, the world doesn't end, the economy doesn't fall apart the next day. Frankly, as much as, most people think, well, if a Democrat goes in, there's going to be higher taxes and so forth, and that's not good. Statistically speaking, the stock market has actually performed better in times of a Democrat in place. Stock markets perform better in the first term of any president in the second term, right? Those are just some stats that my point just being, nobody knows exactly. And if we focus on doing what works, and we focus on investing in a product they're not making more of, workforce housing, where there's incredible demand, where people are going to be in need of housing as we go into, I think what nobody does question is that we are in a recession. We are going to deal with recessionary effects. Actually, housing has been one of the bright spots in all of this for sure. There's going to be volatility. There's going to be challenges, but that creates opportunities at the same point. So we're going to focus here at DLP, not allowing ourselves to get, as we continue to win these cool awards and we continue to grow, we're not going to allow ourselves to get fat and lazy. We're not allowing ourselves to sit back on our laurels. We're not going to allow ourselves to take our eye off the ball of being ready and paying attention to what's going on and adjusting and being ready for whatever gets thrown at us. So feel really good where we're at. I saw, Rich, a couple questions that I saw popping up. I haven't been watching them all. We're asking about the lending side. And I did want to just mention, we focused this on the housing side today to kind of narrow the focus with this big portfolio, but our lending side of our business has done incredibly well. So don't want anybody to think we didn't talk about it because we don't want to talk about it. We actually haven't had any defaults still, knock on wood here. It's an amazing feat through all of COVID. We've continued to hit over 11% returns in every period, including here in July. Reporting, it didn't already go out today, I think goes out tomorrow. So we're doing very well on the lending side of our business as we are on the ownership side as well.
Excellent. Thank you, Don. That was going to be the last question I was going to ask, but since we're out of time, but I will urge everyone, our numbers are up on the screen. We'll leave them up there for a second. Appreciate everyone joining us. We will be back, as Don said, again, coming here soon in another month. So we also have our dinners coming up. So we ask you, reach out to us, any of the investor success managers. We're happy to answer any questions we didn't get to on this session, and we'll continue to answer those questions in the next live webinar as well. Thank you, and have a blessed afternoon, everyone.